All right, guys, thank you so much for joining us today. It is now 5 o'clock, and we want to be respectful of everyone's time. Thank you for joining us for today's first ever Theta IQ Fund Update call. Now, the purpose of this call is quite simple. The purpose of these calls, and they will be on a go-forward basis every second Wednesday. So the reason we didn't have it this Wednesday, obviously it was Valentine's Day, and I think everyone's significant others may have been upset, so we decided to do it for Thursday. 5 o'clock. Let us know if you have any suggestions on timing. If Wednesdays bi-weekly at 5 o'clock works for you. If not, let us know. We'd be happy to take your input into account. Now, the idea, and it's so good, by the way, before I move on, to see some of the a lot of the old so many people from Theta trading here that I haven't seen in a while, like Armadi and Sarmad. It's great to see you guys, and we intend on growing this quite nicely over the number of months and years ahead. It is a very simple concept when it comes to good afternoon, David.
Good afternoon.
It is a very simple concept for us in terms of we want to be different from the industry and keep people informed of what their investments are doing, why, what the environment is like, and that is really, really good. Robert said, "You calling us old?" No, Robert, not calling us old. It's just good to see some old faces. That's all. Yeah, really good. Look at Sarmad. Good afternoon from beautiful Victoria. It's great to see you again, Sarmad. Great to see you.
Yes, Samard is a warrior. When we used to do our, well, not when we used to, but when we do our 10:30 coaching calls, I remember him logging on at, at 7:30 BC time. So thank you, Samad. Your support is much appreciated. So that's awesome.
Yes.
So yeah, like Omar, let's dive right into it. This is something that we have actually been waiting to do for a long, long time, and we're kind of going to go over that a little bit as well. So we're going to start the presentation and tell you what we've been up to. Our set of funds, and specifically the Theta Alpha Fund, they have been operational since the beginning of January. So about 6 weeks in, 5-6 weeks in. So this is the first fund update call. And as Omar said, every second Wednesday, we're going to give you some more transparency in the fund and see where things go, right? So we're very excited about this. So let me share my screen, let's share the presentation, and let's kick this off, okay? So, all right, here we
Do this.
go.
All right.
Okay, you can see the screen, guys?
Absolutely. Thank you, Matthew.
All right, so guys, this is February the 15th, 2024. And we are one day after Valentine's Day. So on the call right now is Omar Khan, myself, Matthew Todden, and David Jarvis, who is from Quarton Capital, and he acts as our portfolio manager and our compliance center there as well. So hello, David. Thank you so much for joining us.
Thank you very much for being
all right. So going forward, just skipping across here, what are we going to talk about today? Okay. So we're going to, the first thing, this is the first call, right? So I think it's really important that we provide some education and say, what does it actually take to take an idea, an investment idea, and bring it to market, meaning have it unitized, available for sales, you can go in and buy it. What does that actually look like? And we're going to talk about that a little bit because there's an awful lot of work that actually goes into that, right? Then we'll have some, current market insights. We're going to talk about dealing with the options market specifically. As you know, guys, everyone is here because they've likely heard of our, Theta Education courses that focus on options trading, options selling. So we're going to have a little bit of insight around that. We're going to talk about our own Theta investment process. Then we're going to talk about actually what's in the fund right now, what we've been doing, some key data. It has only been about 5 or 6 weeks. So there's believe it or not, we've done about 30 or 50 trades, I think. So it's been 55 or 6 weeks. And after that, we're going to see, what the outlook is for the next few weeks up until our next scheduled call. Okay. All right. So here we go. Bringing a fund to market in the Canadian investment landscape. Well, all right. There are a slew of things, and we couldn't be happier to have David help navigate this. And we thought it was steps, 1 through 10, and it seems to be about steps 1 through 10,000. But that's where it is. And to tell you the truth, it's very important that every step is followed so that you're always doing things that are consistent with regulatory practices, and you have the right team in place, right? This industry is laden with regulation, whether you are the investment manager, whether you are a trader, whether you're a salesperson, whether you're in the the fund accounting business, whether you're providing compliance, there is an awful lot of regulation involved, right? We have to engage a lawyer to actually build the products, right? The products are quote unquote built inside what's called an offering memorandum, and a lot of you people have received that document already and are in the process of transferring over funds, and that's awesome. We have vendors, like it's not like you just say, okay, well, it's not like your Interactive Brokers account, guys, that you just deposit money, right? You deposit money to a custodian bank who holds these funds as a third party, so they are independent of the other players. There's a prime broker which does some trade execution for us. There's a fund accounting process which is it's separate and apart from the entities as well, so that they provide independence. So when they're tallying up the wins and the losses, I'm using that as a generality, there's a lot more detail that goes into that, they are separate and apart from us as well, right? Lots of different players. As money comes in, there's a lot of hoops that need to be jumped through. And it's been our experience, Owen and I have been in this industry like for over 20 years, that these transfer-ins can take like up to 20 business days, if you can imagine that, right? So it's not as easy as this kind of EFT to my Interactive Brokers account. It's a little bit more complicated. Finally, when money rests into the account, then it's time for actually the portfolio management function to take place, and thereby the trade execution. That's where Omar and I have provided the education on how we actually do this for ourselves, and now we're doing it professionally along with David's assistance for the public at large. And finally, when the year comes to an end, you do need audited financial statements to provide to the unit holders and the public at large. So there's a lot of little steps that are required to do this thing properly, and that's why it has taken us a long time to get this up and running under our own brand. And here we are. So we're very excited to be here. David, I know this is really this is your cup of tea. Anything else that you'd like to add as kind of like a high level overview of what's required here?
Yeah, I think what Matthew's gone through is correct. I think what people often forget, there's an assumption that this industry is not regulated. Quite the contrary. This industry, the creation of products such as this, they're extraordinarily regulated. Everything, there are a whole set of rules about each component on that list that Matthew has identified. What's expected, who can do what, who cannot do what. I just want people to realize that it is invasive in terms of, or the amount of work, I shouldn't say invasive, the amount of work that is involved is exceptional. And that being said, then we have third-party people who are our agents that we've engaged to help make sure that everything is properly recorded. And yeah, that's and there's a reason why it took them a long time to get here. It is and does take an incredible amount of resources and time to get here. But we are celebrating because here it is, the beginning of 2024, and an idea and a vision that we talked about probably about a year ago is now in existence. This is fantastic. This is why we do this, to get here. Don't worry about all the work that went on behind the scenes to be here. That's our job. This is the life we chose. Thank you.
Thanks, David. I will just comment a couple things here. Thank you, David. A couple things that I'm sure people have questions about is, David, can someone just run away with the money? That's, I think, an overlying question that people have that are maybe willing, not, are shy to ask. But I really want you to comment on how people's money is protected. It's not like in a personal bank account that belongs to Matthew and I. If you could comment on that, that'd be greatly appreciated.
Sure. So Matthew alluded to what's called a prime broker. And so Quarterly Capital has engaged and executed an agreement in this particular case with NBIN. And NBIN is National Bank and Investment Network. It's a wholly owned subsidiary of National Bank, and it's the institutional arm for portfolio managers such as ourselves. So all money is contained in that account. When money comes into your NBIN separately managed account, that is moved in from your account and processed by NBIN into that account. In order for us to move that money into the fund, we have to put up a transaction through FundServe. FundServe is the clearing system, not owned by us, but by all the investment dealers on the street. It's kind of like a shared entity. And that is a clearing system that affects buys and sells. And so that money will come out of your broker account and go into the prime broker account. Corton does not touch the money. And the execution and settlement of that FundServe money is handled by another third party, what are called our administrators, SGGG Fund Services. And so they will ensure that once an order goes through, that we'll put in a buy order in your account. SGGG will work with FundServe, make sure the money comes out and is settled and goes into that account. We are not allowed to move money out of that account, except we're just not allowed to move money out of the account. If money needs to come out for paying an invoice, whatever, it has to be submitted to SGGG, who reviews it, make sure that it makes sense, and they do the accounting, and then they'll release the funds, and they handle the money. In short, Corton Capital does not touch the money. We do not touch anyone's money. We don't have access to it. And all movements, money in and out, are accounted for by SGGG. And in fact, what they do is strike a daily NAV, which means that all money movements, all transactions, all mark-to-markets are reviewed and calculated, and a NAV is struck every single day, which they circulate. Should be in our inbox momentarily. So hopefully that addresses that issue. And so it's very important that people realize that, again, this is all part of how this industry is regulated. We don't have access to the money. Only third-party agents whose business it is to process and handle money can move money. And at the end of the day, we have somebody coming in and striking the NAV or scorekeeping the transactions of what's going on every single day.
Thank you. Thank you, David.
Yeah, so like generally speaking, like, you know, in functions such as these, like there's like an overarching kind of governance and controls, and you know, this would fall into kind of like a segregation of duties type of scenario where, like, you have to be independent of certain functions, right? So like, you know, the person making the trades shouldn't be the person calculating performance, because obviously your independence can be, you know, compromised in that situation, right? So, you know, this industry, you know, there's a lot of brain power within, you know, behind the walls to say, okay, you know, you have to segregate duties appropriately so that so the system is working fairly, right? And that's very important. And, you know, perhaps you could say there's a little too much of it, but you know what? If there's a little too much of it, but it protects the public, well, that's probably a good thing as well. Okay.
Yeah. David, one last question. The auditor. So these funds are audited on an annual basis to make sure accounts, payable, receivable, all expenses are correct. Could you elaborate on that? And also, is it a red flag if accounts, if any fund is not audited on time?
Actually, in point of fact, to not have an audited fund requires exemptive relief from the Ontario Securities Commission. For funds such as this, which are considered prospectus exempt and are created here in Ontario, we are required to have an audit. Again, this is all part of that prescriptive nature. So what happens is our administrator, SGGG, will prepare because they are doing and striking a NAV every day. They also do what's called the trust function, or the URK, unit holder record keeping. And so they keep track of everyone's investment, redemptions, et cetera, distributions. And with that, they put together draft financial statements. They prepare them, and then that package is sent to the auditor, who does their testing and review, and only certain administrators are allowed to be in that business and provide audit packages to the auditors. So, and the same group SGGG also prepares the interim statements that will be coming out in June 30th each year. Those statements are not audited. However, the basis is exactly the same as an audit, and they are sent to you and disclosed as unaudited. But the audited ones, same process, then they go to the auditors for formal review, and we work with the auditors, as does SGGG, to answer their questions, ensure the information is accurate, etc. And then the statements are released 90 days after year end, which means that basically by the end of March, the audited statements will be released.
Thank you, David. All right, so now that that's out of the way, let's get on to the nitty-gritty of what the fund is actually doing. And also, guys, if you have any questions along the way, please ask as many questions as we like. We are going to address them at the end of the call. All right, Matthew. So the markets have been in a bit of a scorching environment. We know that the seasonally strong period of time begins on October 27th, roughly, okay? Now, since October 27th, the markets have been on a bit of tear. You can see January. Pretty good performance on the S&P, the Dow, and the NASDAQ. NASDAQ's lagged a bit. We've had a really good start to the year, and that's something called the January effect. How January does is oftentimes reflective of how the market does that particular year. So we've gotten off to a pretty good start. Now, we don't want to get too much in the nitty-gritty. The U.S. economy is still pretty hot. So what we're looking for the remainder of the year is the economy cooling down a bit, so that interest rates can finally be cut. Now, there's another caveat to this, because this is the year 2024, an election year in the United States. And the Democrats know that if they want to get reelected, the economy has to be in good shape and the stock market has to be doing fairly well. So that bodes well, along with the January effect, for hopefully a pretty good year this year. Now, we added 353,000 jobs in January. That's nearly double expectation. Now, that's not, it sounds like a good thing, but it's not. When you want inflation to come down and interest rates to eventually come down, you want to see the economy soften a bit. It's not softening as fast as we'd like to see it. Unemployment and labor force participation remains high. You can see here, U.S. inflation in January came in at 3.1%. It was below December's 3.4%. And a couple of years ago, guys, we were running at 8-9%. So the whole point of raising those interest rates was to lower inflation, right? You want to cause pain on the economy, lower interest rates, lower inflation through higher interest rates. We're not quite there. The Federal Reserve wants to see 2%, maybe even as high as 3%. We're at 3.1%. When they get closer to that 2% number, that's when we can start looking at some interest rate cuts. Now, that bodes well for both the stock market and the real estate market. The stock market is a forward-looking mechanism. It's looking forward 12 months. It's already anticipating those interest rate cuts. The real estate market's a lagging indicator, okay? Federal funds rate is still at 5.5%. As inflation tames, we want to see this number come down, because think about what it means for companies and corporate profitability. If you're a company and you're borrowing money to grow your company, well, it's much more advantageous to be borrowing at a lower rate and growing your company through cheap debt than it is through higher debt. So it causes a lot of problems in the stock market, and particularly corporate profitability, because it's more difficult to grow your company because debt costs more, okay? So as this number comes down and inflation and interest rates start coming down, that bodes well for the stock market. Now, U.S. GDP in the fourth quarter exceeded expectations. December retail sales shows still a resilient consumer. And the consumer is responsible for roughly 2/3 of GDP, gross domestic product. Again, we want to see softening of the economy, something called a soft landing, right? Where the stock market is anticipating not an absolute destruction of the economy, but a slowing down of the economy. So you want to break the economy, you want to slow the economy down, you don't want to break the economy. It looks like that's where we're headed. But there's still more data points Like I said, where inflation's still clocking around 3.1%. I think we want to see that number right around 2% or slightly above before we can anticipate some interest rate cuts, which the stock market has already priced in because, again, it's looking for 12 months. Let's keep going, Matthew.
There you go.
All right, so current financial markets. Well, 50% of S&P 500 companies have reported, and 80% have beaten expectations, meaning the street issues a number, what they think corporate profitability is going to be like. 80% of the companies that have reported, and they report once a quarter, have reported better. Companies like Amazon, Alphabet, Meta, Microsoft, Tesla, AMD. Tesla and AMD did not beat forecasts, but everybody else did. Eli Lilly did well. We're going to get a little bit more into our holdings in the Alpha portfolio. Now, moving on to volatility. As much as we're sellers of options, we are sellers of volatility, right? When you sell volatility at a high level, you make money simply from volatility going down. Now, volatility is the fear gauge, essentially, of the stock market. It is pretty low right now. It's hovering between 12 and 15 over the last few months. As I said, the stock market has been on quite a run since late October, and this number is pretty low. At some point in time, it's going to revert to the mean. It's going to probably pop up a bit. We want to see that. Now, remember what Warren Buffett said, when others are greedy, be fearful, and when others are fearful, be greedy. Right now, there is a lot of greed in the market that is reflected by the VIX, and we are trading and investing accordingly. So not a lot of volatility in January. We're going to get more into seasonality. Seasonality, we know the markets do exceptionally well from October to May. February is the worst period of that period of time. Okay, so election year. It's an election year, right? It's a big deal. We talked about this earlier. You want the economy and the stock market to be doing well because that's your best chance of getting reelected, and the politicians love getting reelected. So let's take a look at the S&P returns since 1976, the Carter administration in the United States. We're not going to talk about Canada too much, but we're going to talk about this. Now, we've only had 2 negative years. Obama in 2008, and he was just elected then. That was the 2008-09 debacle, the Great Recession it was called, and 2000 under George Bush II. That was the tech meltdown. Matthew and I have been around for both of those. Before that, we entered the industry in the late 90s. Maybe David can comment. But you can see, generally speaking, in an election year, the stock market does fairly well, right? As long as there's not been a major recession or something along those lines. And there's no indication right now that there's something on the horizon. We had a really bad year in 2022. So hopefully this year goes along with past trends and it is a good year for the markets. Now, looking to the US Fed funds rate, this is the important indicator. Again, if companies are able to borrow money cheaply, that is a good thing for them. That allows them to grow the company cheaply by acquiring cheap debt. Right now, we are at 5.5%. By the end of the year, the outlook is, and this is something called a dot plot. We've gone over in a lot of our coaching calls. We're expecting about a 1.15% reduction in interest rates. Now, that's good, again, for the stock market and the real estate market. The real estate market is a lagging indicator stock market looking forward. The stock market already knows this. It knows interest rates are coming. So if there's a negative surprise and these interest rate cuts don't happen, that would not be good for the stock market. Now, if the economy falls apart a little bit quicker and these interest rate cuts are greater, then that bodes well. Now, this does not take into account further interest rate cuts that we anticipate into 2025. Okay, let's keep going, Matthew.
Absolutely. All right. So, guys, at the heart of our operation here is trading in options, and Omar kind of had a nice prelude to that. And what's happening here? Like we do see run up in asset prices in equities, and that is bringing volatility down. We know that, and we are looking for certain relationships between implied, just forward-looking volatility, and historic volatility, which is backwards-looking volatility, right? Or if you want to get technical about it, unrealized and realized volatility. But that we can save that discussion for another day. But we're also looking at what volatility looks like going forward, because we are net sellers of volatility. Like, absolutely, we want to sell volatility high. That's the name of the game here, right? So we are being very, very tactical in how we're placing those trades. It's very important that we do that, because to go back to Omar quoting Warren Buffett, we want to be in the position to be greedy when others are fearful, right? Along with that, yeah, we do apply, exactly what we've been teaching people for a number of years now, applying the Greeks in a methodical and disciplined manner. Strike prices, we are looking at fairly shorter dated trades, 30 days and under for us right now in terms of what's in the portfolio. I think the average expiration right now is 24 days. We'll get into the metrics that we compiled in a few slides from now. And yeah, like those strike prices relating to that are probably within a couple standard deviations of the 20-day moving average, roughly speaking. So we've been very careful because we know that volatility is a low point, stock market's at a high point, and we're just waiting for we are waiting for a potential manifestation of some kind of risk event to pop up there, right? Obviously, our preference is to engage in high liquidity options markets. Pretty much all of our underlying exposure is super liquid on the equities or cash front, but also pretty bloody liquid on the options front as well. Like very, very small bid-ask spreads. You're not seeing 50, 60 cent bid-ask spreads. Oftentimes it's within a nickel or a dime, like literally speaking, right?
Or a penny.
Or a penny, or sometimes a penny. Options markets today, options markets are not what they were like when we started trading options like 20 odd years ago, right? Big differences there. Okay. But again, we do have to be very, very careful in how we are positioning ourselves, because volatility is, as quoted by the VIX, super low. But that does not mean that there's no options opportunities there. It just means that they're a limited amount.
Yeah, so when volatility is low like this, again, others are greedy, right? So what you want to do is you don't want to allocate all your capital. If you have, let's say, $1,000 in your account or whatever it may be, you don't want to be, exposed that entire amount because you're not being paid for it. Volatility is simply too low. So what we've done, and we're going to get a little bit into this in a little later on, is we have allocated a smaller portion of the funds we have, and we are writing options way out of the money. In spite of that, we've generated some fairly good returns. So let's keep going, Matthew.
Absolutely. So we just keep going. Yeah. So our, how are we allocating capital, right? So, we do a combined kind of top up, bottom, top down, bottom approach. It is a bit of a combination, guys. As you know, if you've taken our courses, many of you, I think most of you have, if not all of you have here, we do look at the overall sentiment of the market. It's, we've said this before, you don't want to be swimming upstream. It's tremendously tiring. We want to, we want to have the trend as your friend, and that's kind of a top-down approach, in my opinion, right? And but we do look at what the individual companies are doing, what the themes are in the market and in the economy and in everyday lives, right? And we know that EVs, cloud computing, AI, these are at the forefront of what is hot right now, right? And
not just right now, Matthew. These are themes that are going to play out over a number of years. So they're not just hot right now. They might be scorching hot right now, but they will be the themes that will be playing out in the next number of years.
Yeah, well, and that is certainly our expectation, right? So otherwise we would not be in them, right? So we want to make sure that we have a good gauge on these industries, and that is part of our kind of bottom up analysis. We have an analyst full time which produces research reports to kind of support our investment thesis, and we are in touch with them literally on a daily basis when we are trading, and for kind of fundamental feedback on these companies, right? So very important that when especially during 2020, guys, during COVID, the idea of like what's your investment thesis, that got kind of thrown out the window to a certain extent, because people had a lot of time in their hands, and the stock market was going wild, right? So when the stock market is going wild, often the investing public just wants to jump on the bandwagon and not necessarily transcribe an investment process, right? But it's very important when you do this, when you do this, for the public, that you actually have a very good line of sight as to why you're doing certain things, right? Has to be very defensible, right? Defensible is a very, very important word to me, because you want to make sure that all these trades, all this portfolio management activities are defensible to your future self. Absolutely. All right, so let's get into the actual Theta Alpha portfolio, guys. So right now, this is a list of holdings, guys. So you got Google, you got Amazon, Apple, Microsoft, Tesla, AMD, Meta Platforms, formerly Facebook, Eli Lilly, TSM, Nvidia, Airbnb. So,
Taiwan Semiconductor.
yes, Taiwan Semiconductor, correct. And all these names are pretty much household names. All these have positive EPS. Fundamentally speaking, in our opinion, fundamentally they're relatively strong companies as at the moment. And we have full blown research reports on these issues as well.
Matthew, I'd like to add something here.
Yeah.
Guys, the typical fund in Canada holds 200, 300 positions. We are not looking to be like the typical fund. With that, there'll be more volatility. However, we believe that over the time, we can achieve a greater return because we are not looking to look like the markets. As you can see, we are taking outsized bets on the industries and companies that we believe in, the EVs, cloud computing, AI, etc. You can see a holding like Apple or Amazon or Microsoft, Tesla, Eli Lilly. These are 10% plus holdings. This is not typical of something that is done in the industry. But the reason we are doing it is because we believe in these companies. And the reality is, beyond about 15, 18 stocks, you don't get a whole lot more diversification. This is why the vast majority of funds in Canada underperform their underlying indexes. So if the S&P does 10 or 11 that year, most funds over time will lose. Why? Because they look too much like that index. And once you minus the fees, it is very difficult to beat the index. We are the antithesis of that. We are looking to beat the market. We do a lot of research on the companies that we want to own, and then we write options on them, ideally when volatility is high. Correct?
Can I add an extra comment here?
Absolutely, David.
From a portfolio management perspective, 10% concentration is not extraordinarily outrageous. What makes with 10, 11 different names, 12 names, yes, it is significantly lower than your typical fund. However, what you really should be looking at, the concentration here is that these are growth stocks. These in multiple different industries. That being said, the theory is that over time, despite the volatility that occurs from one month to the next, over time, these companies are going to generate outsized returns because of their commitment and demonstrated commitment and history of being able to innovate and capitalize on their innovation. Yes, it will be volatile, as Omar said. However, it is not the same thing as investing all your money in one stock and leaving and hoping that that one stock is what's going to deliver to the end, deliver you to the promised land, as they say.
Yeah, the other thing I'd like to note here is like when we're talking about current exposure, guys, we are talking about long plus any short options exposure there. And also this is marked as of a certain date. I believe it was a couple of days ago, right? So yes, you do see Eli Lilly as a 0, but like if you talk to us on like maybe last week this time, it wasn't. It was probably about 8%. Right, so this is marked as of a certain date, and this is our desired exposure. And we are trading in and out of these items. We make sure that we don't really go beyond these thresholds. We went a little bit beyond these thresholds with Tesla simply because of some rounding, but that's about it. So these numbers do fluctuate just a smidgen because of us trading in and out of them, right? All right, let's keep moving on here, guys. So what does this look like in terms of what we are doing? So right now, outstanding exposure percentage of AUM. So it's 55%, right? So what this really means is that like if we were to sign on everything right now, we would have chewed through about 55% of our AUM. So that means like roughly 45% of this is unencumbered cash. Why are we keeping such a high cash balance? Because volatility is super, super low and markets are at all-time high. That's really the investment thesis behind that, right? Because we want to, as to reiterate Omar's comment, to be able to be greedy when others are fearful in the event of a pullback.
Yeah, so we're writing puts way out of the money. If everything were assigned to us today, only 55% of our cash would be utilized here. Also, there is a lot of cash that is coming in. So we'll have a lot more opportunity. But really what we're waiting on is for this volatility number to pop up. and for us to be able to make some pretty good number and get into some positions once volatility pops up. In spite of that, we have generated some pretty good return on premiums that we've collected so far. So we've collected about 1.3% in premiums already. That is a
based on AUM, which is actually including cash.
Including cash, yeah. So we've collected a lot of money in premium already. We only have 5% exposed in stock right now, and that's only in Tesla when we've written covered calls on them already. So you can see, even though we haven't been assigned everything and the market's been on a tear, we've done pretty well, 1.3% just in 6 weeks. And this is simply the beginning phase. As capital moves in, we believe that we can generate a lot of money simply from receiving premiums. Because again, we are writing these puts and calls way out of the money. Volatility simply isn't high enough for us to be aggressive right now.
Can I have a supplemental comment? Lorianne may ask a question. Will you ever own the underlying? And the answer is yes. But since the fund is in the first stages of development, the primary focus is on selling puts, which creates an entry point for establishing a position. And yes, the Tesla position was established by the assignment of a put, and from there we'll go in and start selling calls against it. Over time, we will see more and more positions or short put positions being converted to stock, and the fund will migrate and increase its selling of calls against existing positions. I just wanted to make sure that people understood the progression. We're in the early stages of what the fund will look like.
Yeah, and to add to that, I mean, we want to get into positions at prices we are comfortable with, not necessarily go with the market. It's like, oh, it just happened to be at the all-time high. Well, why not? Let's go long that. It's like that's not something that we are wanting to do, right? So, and I personally don't think that makes very much sense. So we are going to allocate capital, tactically, however, with like kind of a longer range view of things as well, right? So eventually, yeah, we're gonna, you ask us in 3-6 months, yeah, absolutely, I could definitely envision us having a whole bunch of longs and us still trading options, selling puts and selling calls around that as well. But for now, we're not going to be forced to jump into positions that we don't want. And as we've told you guys before, sometimes no trade is the right trade.
Correct. And right now, because volatility is so low, we're choosing not to trade too much. As volatility starts increasing, these numbers will increase.
Yeah, and one other thing, of the premiums collected as a percentage of exposure, meaning the capital that we actually have at risk, meaning the cash which is secured against the written option, guys, that's about 2.4% on average. So I think that's actually, and at positions and at levels we're pretty comfortable with. So I mean, I think that's a pretty good metric there, especially in this low volatility environment. And lastly, our days to expiration, we do know what happens at time decay after the 45-day mark. We're like, not quite half that, but we're about half that as well, right? So at 24 days.
Yeah,
all right.
To be able to collect 2.4% so far on the money that we've exposed, that's been a really healthy return considering the market's been on a tear and we're in a low volatility environment. This average days to expiration is it's gonna be probably around that 15 to 35 day mark, depending again upon volatility. But 24 is something that you can probably get used to going forward.
Great, absolutely. All right, let's continue on here, guys. So, what are we looking to do next, right? One, we are looking, the market has run away a little bit here, going into 2024, starting 2024. We're going to be very cognizant of that as we're allocating capital. We've talked about that. We're going to be monitoring these low volatility levels. We saw that, when it's kind of like implied that the street was thinking that interest rates will only be kind of starting to decline at the back half of 2024. We saw a bit of a sell-off a couple of days ago. We're going to continue to monitor that. That didn't have too much of an impact on volatility measured by VIX. It did jump up, I think, 12 or 15%. But again, it was so low to begin with that really only translates to about 2 percentage points, right? And we're looking for that to be a heck of a lot more, right? Obviously, the theme currently, and outside of risks which we are unable to identify because they are unknown, we do believe that inflation, interest rate, and their forecast for the continuing year are the main themes that we're going to look to play out, right? So, you know, and maybe towards a later part of the year, the election is going to take a little bit more of a toll, but that might just be, you know, a little bit of a few bumps along the road until things smoothen out. All right, Omar, David, anything else in terms of forward-looking events? Anything else you'd like to add there, guys?
No, one thing I want to say is we take seasonality into account. So we know from October to May, the markets do pretty well. And that's been the case so far since late October. When the summer months hit, we're looking to get into positions once volatility hits. And then when the summer months hit from, let's say, May 5th to October 27th, that's when we're going to look to be more aggressive writing covered calls. There's a few questions that we're going to answer at the end. I know there's a few questions on how much cash do you plan on holding. We'll answer those questions. But the main theme we're looking for right now is volatility to go up, markets to come down a little bit here, and eventually later on this year for interest rates and inflation to come down.
All right. So we're going to this kind of, we'll get to Q&A after this, guys. So again, here's our contact information, guys. I believe Omar has probably reached out to almost everyone on this call. And we'll be publishing this this call, and this kind of brings us to the end of this official presentation. We'll do some Q&A afterwards. So here's Omar and my contact information. As I said, Omar's been in touch with you guys already, and yes, thank you so much for joining. Can't have an update call without a wonderful disclaimer, guys. So you know, to keep the compliance folks happy, very important that we are always on site here. That means the world to us that we do things in such a manner that we don't need to worry about, oh, did I miss something here, right? So it's very important. And again, as always, great big thank you for all of your support since we started this endeavor.
Yeah, we can't thank you guys enough. Without you guys, we wouldn't have been able to do this. It's been our lifelong dream to open this up and to implement a strategy that has worked for us personally, and now to be able to do it on a larger scale with the control and the right guidance and team along with David and his team. So let's move on to questions. We cannot thank you guys enough. Let's look at some questions here. All right. Chat. So I'm going to answer the chat questions first. And again, please